Earning money across borders is now standard for freelancers, remote workers, and investors. But this capital flow triggers overlapping sovereign claims on the same income. Under the Indian tax code, your liability on foreign income is not a matter of citizenship. It is governed by a specific legal calculation. If you earn 10 lakh rupees from a client abroad while living in India, the government views that as taxable. Without intervention, this leads to wealth loss, paying full tax where the money was earned and full tax again in India. To prevent this, we must look at the 1961 Income Tax Act rules, the 2026 tax slabs, and the specific mathematical credits used to reconcile these two jurisdictions. International taxation is a system of precisely defined limits. Understanding these rules is the only way to calculate exactly what you owe and keep what you earn. Every tax calculation in India starts with one variable, your residential status. The tax code uses a physical day count to determine your status. Spending 182 days or more inside India makes you a resident. Once hitting that threshold, the government taxes your global income. Both domestic and foreign revenue funnel into the same taxable bucket. For a resident, geography no longer limits tax liability. Your worldwide earnings are subject to Indian tax rates. Spending less than 182 days in India classifies you as a non-resident Indian, or NRI. This status changes the jurisdictional limit. Your global income stream is ignored by the Indian tax system. Only money earned or received within India remains taxable. There is a transitional category called resident but not ordinarily resident, or RNOR. In this state, foreign income is generally exempt unless it is derived from a business controlled within India. Most compliance issues arise from taxpayers miscounting their days and applying the wrong rules to their foreign earnings. Physical presence is the primary trigger that determines whether the Indian government can tax your global wealth. We can see this in action by looking at Rahul, who is a resident Indian for the current financial year. Rahul has two income sources, an 8 lakh rupee Indian salary and 10 lakh rupees from US freelance clients. As a resident, the first step is combining these streams into a single total of 18 lakh rupees. Now we process that 18 lakh total through the 2026 new tax regime slabs. The first 3 lakhs of his income are taxed at 0%. The next 3 lakhs, from 3 to 6, are taxed at 5%, which equals 15,000 rupees. The slab from 6 to 9 lakhs is taxed at 10%, adding 30,000 rupees to the bill. Continuing up the tiers, 9 to 12 lakhs adds 45,000 at 15%, and 12 to 15 lakhs adds 60,000 at 20%. The final 3 lakhs hit the 30% slab, generating 90,000 rupees, bringing the base total to 2,40,000. Adding the 4% health and education cess results in a final Indian tax liability of 2,49,600 rupees. At this stage, the system treats Rahul's US income exactly like domestic income, demanding nearly 2.5 lakhs in total taxed. Consider what happens if the US government has already withheld 1 lakh rupees in taxes on that freelance income before it reached Rahul. If Rahul pays that 1 lakh to the US and the full 2.5 lakhs to India, he is being taxed twice on the same 10 lakh rupees of income. To prevent this, India uses the Double Taxation Avoidance Agreement, or DTAA. This is a treaty network designed to coordinate tax claims between two different countries. Under this agreement, you can claim a foreign tax credit. Form 67 is the document required to notify the Indian Tax Department that you have already paid tax on this income in another country. The foreign tax credit acts as a direct deduction. India recognizes the 1 lakh paid to the US and subtracts it from the amount you owe domestically. This reduces Rahul's remaining payment to India to 1,49,600 rupees. The DTAA ensures you only pay an amount equal to the higher of the two countries' tax rates, rather than a combination of both. This mechanism reconciles sovereign claims, turning a double tax penalty into a single adjusted payment. The outcome changes if we apply these same rules to an NRI. Because an NRI's foreign income is not taxable in India, the 10 lakh US income disappears from the calculation. The tax is calculated only on the 8 lakh Indian salary, resulting in a significantly lower liability without the need for DTAA credits. Faster, more urgently. However, failing to apply these rules accurately leads to audits and penalties. The tax department has systems to flag international inconsistencies. A common error is failing to declare foreign income entirely, assuming that the Indian government has no visibility into international bank transfers. Another error is claiming NRI status while staying in India long enough to legally qualify as a resident. Many taxpayers also forget that DTAA relief is not automatic. It requires filing Form 67 on time to be valid. Finally, the government tracks foreign assets. You must report overseas bank accounts, stocks, and RSUs in your tax return, even without generating immediate income. If you are managing income from multiple countries, comment Global Income below. Our next video explains the specific systems the Income Tax Department uses to track foreign assets. Subscribe to Kuber Edge to stay updated. Managing international earnings requires strict adherence to residency rules and treaty provisions. Correct application of these laws allows you to retain your global wealth.